Good evening, and welcome to Investing Beyond the Basics with Scott Hahn. Today, we will take a deeper dive into the concepts associated with investing and discuss the difference between investing and speculation. This program is a part of Career Success Month 2024, Future of Work, hosted by Maryland Public Libraries, and provides community members with guidance from experts on a spectrum of business, entrepreneurship, and job investment topics. Some of the topics included are how to work the gig economy, the joy of owning a small business in retirement, learning Canva graphic design, mindfulness at work, and many others. We have over 80 classes that we are offering over this month. And for the complete schedule of the Career Success Month classes, I will be sending out a link after this class is over via email. And you can browse through that list and see whatever else is of interest to you. Before we start and I introduce Scott, please mark a couple of dates. We have the Design Thinking Primer on Feb 7th at 6:30 p.m. If you're starting a business, nonprofit, or re-examining your career, you might want to explore design thinking, which is a mindset and a practical toolkit to make a well-designed product or service. That will be presented by Vance McEwan. He is the entrepreneur in residence at the Maryland Innovation Center and the founder CEO of The Greatest Possible Good, a social nonprofit organization. I'm Rohini Gupta, Adult Learning and Innovation Specialist with the Howard County Library System. Please use the chat box to put in your questions for Scott. And this is in a meeting format while you are muted. If you have questions, you can ask to be unmuted and ask your questions. Scott would prefer it to be interactive and he welcomes all your questions. So please do feel free to ask your questions in the chat or just to say it out yourself. This event is being recorded, and after the event, we will send out a survey and would love to hear from you. And now, a brief intro of Scott, who has been really amazing and generous with his support for the library. Scott began his career in financial services in 2010, and before he joined Harbor Investment Advisory in 2018, he spent 6 years at a local independent wealth management firm. Scott earned his BA in Business, Organization, and Society from the Franklin and Marshall College. He was also captain of the men's lacrosse team. He achieved the Certified Financial Planner certification in 2016 and the Chartered Retirement Plans Specialist in 2022. Scott is a registered rep with and an investment advisor with Harbor Investment Advisory. And I must also add the disclaimer that all the information in here is for informational purposes, and you may choose to, apply it as you would wish. This is just an educational seminar. Welcome, Scott. It is wonderful to have you with us, and thank you for taking out the time this evening to come and talk to our community.
Great, Rohini. Thank you for the introduction here. And I want to say thank you to everybody for joining me at 6:30 on a Wednesday evening here. So appreciate the introduction. So first and foremost, I want to start off, I am a Howard County guy. So I actually grew up right behind the Miller Library. So my folks still live over there. So I'm in the area all the time. So my day job, as Rohini mentioned, I am a financial planner with Harbor Investment Advisory, but we have actually partnered with a nonprofit, the Association of Financial Educators. So we actually travel the country and have speaking engagements just like this, where ultimately we wanted to give back to our communities. A good bit of our daily business is actually, a good chunk of it is actually going out and speaking with retirement plan participants and educating them not only about the ins and outs of their retirement plans through their employers, but also kind of finance 101, things that are not related to retirement plans. Maybe it's just general investing, whatever the case may be there, we definitely tackle numerous different topics. So we wanted to keep this, not necessarily on the basic level tonight, but ultimately dive in to the investing landscape here. So I am going to share my screen here without further ado. Please feel free to stop me here. I want to make this as interactive as possible. So, if there's a specific topic that, someone is extremely interested in, please let me know. We can open up the floor and have a discussion. I'll do my best to answer as many questions as possible. Full disclosure, I'm probably not going to have all the answers, so I'm going to leave my contact information on the last slide there. I promise, I'll do my best, either offline or at the end to see if I can get you the answer there. If I need to go tap another resource in order to get you your answer, chances are it's probably within my wheelhouse. So bear with me real quick here. I am going to share my screen. Right. Just here. All right. Can everybody see this? Just to get started. Hopefully somebody give me a thumbs up just in the chat. All righty. Thank you. Okay. So we'll get started here. So the topic tonight is investing beyond the basics. We're going to tap into some savings and investment strategies. Just a quick overview. We're going to touch on investing versus saving, considering some risk, and the terms and definitions outlined in this presentation. So before we can do that, we always take a look at this through the lens of financial planning. So we're not going to touch on all of these, but ultimately, we can't start talking about investing until we address a couple of the basics from a financial planning perspective. So when you think about a financial plan, the first step there is setting goals. Next is budgeting. We'll briefly discuss, touch on setting up an emergency fund, different types of insurance, using credit, tax planning, saving for college, retirement planning, and estate planning. We're not going to dive into too much, but ultimately, we just kind of want to lay the groundwork here so that we can kind of move into the investing landscape and get into the weeds with a couple different strategies that may be of interest. So the first step here is establishing goals. So what exactly are you trying to accomplish here? And that is ultimately going to pave the path to get us into the investment landscape. So, whether you're in your first job, and you're just trying to figure it out from a financial standpoint, whether you just got married, perhaps you just had your first child, you're trying to figure out, okay, well, how do I keep track of what's coming in, what's going out, especially with another member of the family now? Perhaps you're trying to make sure that you're covered in the event that you're not around. You don't make it home from work today. You're the breadwinner. How do you provide for your family? So what are you trying to accomplish here? That's kind of step one. And you've probably heard this acronym before here, but when we're actually going to establish goals, we use this acronym SMART. So that stands for specific, measurable, attainable, relevant, and timely. And what I mean by that is specific. So you want to make sure that your goals are clearly defined. So for example, I want to save for my child's education is not super specific. We always urge folks to say, hey, I want to save for the cost of 4 years of Florida State University by the year 2030. So measurable. I want to retire early. Well, make it measurable. No, I want to retire by the age of 55. Attainable. Be realistic. So you tell me, hey, Scott, I want to save $1 million by tomorrow. That might not necessarily be attainable for most Americans. But if you want to save $1 million and have an investment portfolio of that nature in 30 years, well, it very well could be doable, provided you make the right investment decisions today. Relevant. So make these goals make sense to you and make them exciting. So, if I want to save $25,000 for a down payment on my first home, well, that excites me. It might not necessarily excite my neighbor down the street, but make it relevant to you and timely. So set a time frame or a deadline in order to reach your goal. So for example, I want to pay off my credit card debt by the end of 2024. That would be an example of making something timely. And last but not least, write them down and prioritize your goals. So budgeting, I know this is finance 101 for most folks here, but we really can't get into the investment landscape without addressing budgeting first. So, what's coming through the door versus what's going out. So, income. Think of yourself as a business. So I always do this myself using a spreadsheet every single month. Think about revenue less expenses equals either a profit or loss. It's the same exact thing with a household budget. So think of your income, which is your paycheck. Perhaps you have a rental property, any government benefits, perhaps some interest from bonds, savings accounts that may be generated, and investment income, less whatever expenses you have, whether that's fixed, like insurance payments, mortgage, auto payments, less your discretionary expenses. And then you either have a surplus or a deficit at the end of the month. And this is important too. Once again, I know this is super, super basic, but getting into it, we always urge folks, first and foremost, after you establish a budget, you definitely want to set up an emergency fund. So we can't start talking about the really, really fun stuff when it comes time to invest if we don't have what we call our safe cash taken care of. So as far as an emergency fund goes, kind of the old rule of thumb, and this has changed a lot, and we're seeing it a lot in our industry since COVID. The old rule of thumb was, put together, your rainy day fund and make it worth 3 to 6 months of your fixed expenses. So think of those topics again here. So, your auto payment, your mortgage, insurance payments, things that you can't go without. So I'm not talking, Netflix, discretionary spending, going out to the Orioles or the Ravens games, perhaps, going out to eat. So think of what your fixed expenses are and multiply that by 3. I would definitely start there, start small, and ultimately build that up. It's different for everybody. So some folks are comfortable with 3 months of their fixed expenses in a rainy day fund. Others are completely comfortable with 6. We're seeing more and more people, strive to go for a year or more, just given what happened during the pandemic. And that's really just if you were ever, sick, injured, you needed to tap some cash quickly. You don't want to tap your investment accounts for an emergency or, in the event that you need cash in a pinch. And in addition, that last part there, also, where do you keep an emergency fund? So this is becoming more and more prevalent, especially today, given where interest rates are. So, if you use just a brick and mortar bank, you'll notice, unless you're using a high yield savings or some sort of CD money market fund, just double check, just make sure they're giving you some sort of interest. You'll notice a lot of the online banks, and I know this is, topic that's up for discussion because some folks are really comfortable with online banking, myself included. I don't need a brick and mortar bank, but at the end of the day, the online banks actually have the opportunity. Most of them will pay you a higher yield than you'll get at your brick and mortar bank. And part of the reason is a lot of the online banks just don't have the overhead. So, full disclosure, just a couple that you may just want to take a look at if you don't, currently use an online bank or something with a high yield savings. Ally Bank is good, Capital One 360, and Synchrony Financial. They all have high yield savings right now, and typically the rates are above 4%, subject to fluctuation, of course. So let's dive into the basics here. So what's the difference between saving and investing? So saving provides funds for emergencies and for making specific purchases in the near future. Investing focuses on increasing your net worth and achieving long-term financial goals. So then we'll dive into speculating versus saving. So investing is a carefully planned and prepared approach to managing money with the goal of accumulating the funds you need. So buying an investment, this means putting money into an asset that generates a return. Speculation is certainly not the same thing. This is purchasing assets, equity or debt, because of an assumed value. So some of these examples could be gold coins, baseball cards, gems, and I would even argue Bitcoin at this point in the game. So let's talk a little bit about investment objectives. So typically there are 3. It's growth, income, and stability or capital preservation. So growth, just as it sounds, the goal here is to increase your portfolio and ultimately achieve an increase in market value. Income, think of this, could be somebody who's in retirement that is trying to generate income, interest, and dividends from their portfolio. And stability would ultimately be on the safe side of things, where the ultimate goal is trying to protect the original principle of your investment. So the next topic we want to address is risk. There are several types of risk. There's interest rate risk. So the higher the interest rate, the less the bond's worth. So this typically comes into play with fixed income. Inflation risk, as I'm sure we've all seen here within the last couple of years, rising prices will erode purchasing power of both goods and services. Business risk, so effects of good and bad management decisions. Financial risk, associated with the use of debt by the firm. Liquidity risk, so the inability to liquidate a security quickly and at a fair market price. And market rate risk, associated with market movements. Any questions so far on anything we've covered? Please feel free to stop me. This is
I think there's a raised hand from Priya.
Okay.
If she wants to ask a question.
Yes, Rohini. Thank you. Hi, Scott.
Priya, how are you?
I'm doing good. How are you, sir? Thank you for
taking
the time today. Yes. No, actually, if we can go back few slides between the investment and the speculation.
Sure.
I was kind of surprised looking in the examples of speculation gold coins. I always had that thought that gold coins are the investments.
Sure. Yeah. So gold. I'm sorry. I just want to find the.
No. Yeah. I think the next one.
Yeah. I'm sorry. Went back too far. Yeah. So gold coins. That's a really, really good question. So, gold kind of falls into the alternatives bucket. At least that's how we see it. So, when you think of gold, ultimately it's not a traditional asset class. So, that falls into the alternatives. So, the price of gold does fluctuate. And I do think, and take this with a grain of salt, that there is a place for alternatives in your portfolio. So when we think of alts, we think of gold, we think of real estate, whether that's publicly traded, non-traded. We're using a lot of private credit at this point. But there's all kinds of different alternatives that you can use inside of a portfolio, whether that's commodities, what have you. So you're absolutely right. Gold does have a value, and there are different ways to purchase gold. So you're absolutely right. I probably shouldn't have lumped gold into the speculative side of things there. Because gold, the market value does fluctuate. There is a market for it. And I definitely wouldn't lump that into probably the same bucket as gems and baseball cards. So I do apologize. I do think you have a very, very valid point there.
Thank you so much, Scott.
You're welcome. Sorry, any other questions so far?
I think we're good.
Okay, perfect. So there are a couple different ways that you can mitigate risk. So a couple of those different ways are diversification and asset allocation. So simply meaning don't put all your eggs in one basket. Diversification allows you to reduce your risk without affecting the expected return. And asset allocation. So, your investment returns are associated with the types of assets that you select. So, one of the goals here, we're going to dive into the different types of investments, but the long and short of it is you never want to throw all your eggs in one basket. You want to spread out your investments depending on what kind of portfolio you're trying to craft. Not only across U.S. markets, across international markets, both in the equity markets, fixed income markets, and alternatives. There are all kinds of different solutions that you can use, and a lot of math goes behind portfolio construction so that you're able to achieve the goals that you're trying to achieve. So here we call this the asset class quilt. So here we're going to dive into this a little bit, and I apologize. My numbers here are not up to date for 2023. I am hoping those come out shortly here, but this was the one I could get my hands on. So if you take a look here, you'll notice these white boxes are what we like to call a 60-40 diversified portfolio. And each of the colors represents a different asset class and a different part of the market, along with the year's corresponding returns. So all this is meant to show you is that it's very, very difficult to time the markets. So, for example, if you take a look at 2020 and you look at the worst performing asset class, which was REITs down at the bottom. REITs, so for the folks that are not familiar with that term, stand for Real Estate Investment Trust. If you look at the returns on REITs the next year, 2021, those generated a return of 41.3%. As you can see, that's a pretty large discrepancy. But if you take a look at 2022, and a lot of this was due to the interest rate environment, you look at where REITs wound up. Well, total return on REITs for 2022 was negative 24.9%. So getting back to diversification and asset allocation, as I mentioned, it's really, really tough to time the markets, and things just don't move in tandem. So, as you can see here, all of these pretty colors, something that does really, really well one year might not necessarily do well the next year. And that's why you want to build a diversified portfolio and ultimately incorporate, large cap securities, mid cap securities, small cap securities, different portions of fixed income in several different sectors, and ultimately, spread your money out. Not only, you certainly want to have a heavy bend towards U.S. securities, but we still think, there could possibly be some value in incorporating some international and emerging market securities in your portfolio too, if you're trying to achieve that 60-40, moderate portfolio that you're kind of seeing in the white there.
So we do have a question from Lisa.
Okay, Lisa.
Yes, hi. So I wanted to ask you, everybody talks about diversification in terms of asset allocation, but do you extend that to diversification in terms of brokers and brokerage houses? Because that seems to be an issue as well.
Interesting. So are you referring
I know.
to... No, Yep. So are you referring to having like multiple advisors?
Exactly.
Got it. So that's a really interesting question. I know some folks subscribe to that mantra. I know others that don't, because there's several. I guess there could be some pros. We more often run into the cons, and part of that has to do with asset allocation and rebalancing. Unless you have a team of advisors, like an estate planning attorney, a CPA, and a financial advisor who are working together, typically relationships across wirehouses and different investment shops don't necessarily work within that realm. Now, I'm talking out of a couple sides of my mouth, because there are instances where it does work, and I've seen it, because I have seen it kind of in my my the course of my career, but more often than not, it tends to be a little bit of a competitive situation, for whether that's right or wrong. But part of it too is, if you spread your assets across multiple firms, number one, you always want to be aware, and you want to make sure your investments are being managed appropriately across the board, because what we often find is, if you have several different accounts with several different registrations at multiple brokers, well, the real issue that you can run into deals with this asset allocation and diversification, because with one talking to another, or one advisor, not talking to another, you could easily wind up in a situation where you're over allocated to one specific sector of the market. So, if both advisors, or 3, 4, 5 teams of advisors really think real estate's great, or everybody thinks Apple is going to the moon. Well, if everybody's putting all your money in Apple, well, what happens? Knock on wood, I don't think Apple is going to zero. Stranger things have happened, so full disclosure. But at the end of the day, you could find yourself with an over concentrated portfolio.
Right.
But it's a very, very good question. Extremely good question, because we've ran into that a couple times. So that's a personal decision.
Yeah. Okay. Thank you.
Sure. Excellent. Any other questions so far?
Not
Okay. Perfect. Well, I'll keep moving here. So the three main asset classes are stocks, bonds, and cash. So stocks tend to be higher risk, higher reward. They represent ownership of companies. Bonds tend to be somewhere in the middle. So, moderate risk, moderate reward. And these are nothing, when you hear the term bonds or fixed income, simply means nothing more than loans. So, you're loaning money as an investor out to governments, whether that's the U.S. government, governments overseas, municipalities, could be corporate bonds. You're lending money to institutions so that they can go and plow it back into R&D and ultimately use it for their operations. So, and then of course, the third one, which is the least risky, is cash. So bonds. So when we refer to bonds, as I just mentioned, typically when you're investing in bonds, you're looking to produce steady income. So if held to maturity, bonds are a relatively safe investment with low risk. Now, given there are different types of bonds, which we're going to get into in a minute or two, but a couple key terms here. So par value, that refers to the face value or the return of the bond at maturity, and the coupon interest rate. So that's the percentage of the par value that is paid out annually. Here are the different types of bonds. So these are just a couple of the different types, actually. So corporate bonds. This allows firms to borrow money. Treasury and agency bonds. Agency bonds are virtually risk-free with higher interest rates than treasuries. Muni bonds, they're tax exempt. They come in serial maturities, not entirely risk-free due to some of the credit risk of the municipalities themselves. And junk bonds. These are the lowest rated or highest yield. They have a greater risk of default than municipal bonds, treasuries, agencies, and corporate bonds. And typically they're callable, which means that the issuer can call them back and reissue them at an altered interest rate, which essentially means refinancing. Now we'll touch on some of the fun stuff, which is investing in stocks. So common stocks. This means, as I mentioned before, purchasing a part of a company. You're investing in stocks because there are possible dividends and capital appreciation. Many are limited liability. Companies may repurchase their own stock. And some of these different types of stock are blue chips, growth stocks, income stocks, speculative stocks, cyclicals, and defensives. This one's gaining a lot of popularity as well, since most folks tend to see a lot of mutual funds inside of their retirement accounts and even their personal portfolios. So some of the benefits of mutual funds, they're professionally managed pools of capital. They're minimal transaction costs, and may offer higher returns just due to their diversification benefits. And there are several to choose from. So individual stock and bond trading, this definitely requires a little time and expertise. So, if you're trying to outsource your portfolio and professional management, it might make sense to use mutual funds since they tend to be professionally managed. There are some that invest strictly in indexes, but if you're going to be buying and selling stocks and bonds, you really want to know what you're doing. So depending on the brokerage house, just be wary that some of them have higher transaction costs than purchasing mutual funds, and they're much less likely to have proper diversification since ultimately you're investing in specific companies or specific fixed income instruments rather than mutual funds where things are pooled with other investors. And I'm sorry, I think I see
there are a couple of questions in the chat.
Couple questions. Aren't non-junk bonds callable too? They can be, absolutely. Is a mutual fund a good investment, and do you pay higher tax on a mutual fund? So across the board, that is kind of a loaded question because it depends on what your goals are. So we're going to get into the different types of taxes in a moment here. But there are some really good mutual funds out there. There are some really bad mutual funds out there. So same thing with stocks. There are some safer companies and there are some really, really good companies that have great balance sheets, pay dividends. And it ultimately depends on what your investment objective is. So, if you're trying to really, go uber risky, and generate the highest return you can, there are definitely some ways you can do that either through individual equity investing or through mutual funds. But great questions. So I'll keep moving here. I know we talked a little bit about mutual funds, but yeah, as I mentioned before, they're pooled vehicles. So they bring together the money of many different investors. So if you hold a mutual fund, it's not the same as investing in just Apple itself. So if you invest in a large growth mutual fund, well, you're going to have several, possibly thousands of securities within that fund. So they typically hold a mix of individual stocks, bonds, and or cash. It does give you some diversification because they do hold several securities rather than one individually. And the mutual funds, each fund, if you really get under the hood there and you read what's called the prospectus, each mutual fund has an investment objective. I just wanted to provide this briefly here. So just to give you a kind of a brief overview as to where things have stood historically. So U.S. stocks over the last X number of years there, 1926 to 2023, have returned approximately 10.3%. So I just thought that was a really, really neat statistic, especially for folks that are kind of new to the investing landscape. So it's just a really, really good way in order to play the markets and accumulate wealth. So this stuff doesn't need to be super, super daunting. There are some ways, some easy ways to invest, which we're going to get into in a little bit here. But ultimately, the power of compounding when you achieve 10.3% rate of return annualized is amazing. We're going to see that in a couple minutes here. So just to give you a glimpse as to what happened in 2023, if you have flipped on the news, you probably heard of the Magnificent Seven. Just wanted to show you, what the rates of return were for, it's crazy, the 7 stocks that actually drove the majority of the returns in the market. So, you've got Meta there with a return of 194.1%. You've got Tesla next. You've got, NVIDIA. I mean, you could just take a look here, and it's clear that the returns there, while they were concentrated, it was actually the growth names that actually really, gave the markets a boost in 2023. So this is one of the biggest things when it comes to investing, and it's one of the mantras. So you want to focus on time in the market rather than timing the market. So this just goes to show you here, this chart. If you invested $10,000 January 1st of 1980, if you invested all days and you never touched it, well, your portfolio is going to be somewhere in the range of about, $650,000, as you can see. If you missed the 5 best days, just 5 days, your portfolio is just going to be over $400,000. If you missed the 10 best days, well, ultimately, your portfolio is going to be shy of 400,000 again, and it looks like a little over 300,000. If you miss the best 30 days, ultimately, you're sitting at approximately 150,000, and if you miss the best 50 days, you're right at about $50,000 there, give or take. So it's crazy. Ultimately, it's really, really tough to time the markets, and very, very few people can do it effectively. So, once again, the mantra here, diversification works. I'm not against investing in individual equities or bonds or what have you. If you have a company that you really, really like, that you like to follow, awesome. But, just given historical returns, this just goes to show you that, even professionals are wrong a lot of the time, and ultimately institutions invest for the long term. So let's get into a really fun topic here, which are taxes on investments. So a lot of people ask these questions all the time. So, how are my investments taxed? So typically you're going to run into 2 different types of taxes on investments. So first is ordinary income rates. So think of ordinary income as, what you earn. If you're a W-2 employee, ultimately, that's your gross wages for the year. So, if you get interest on your savings account, perhaps you get interest on a bond. I say that most because, if you live in the same state and you buy a muni bond, they're actually tax-free, both at the federal and state level. But ordinary income just reflects, ultimately the higher of the rates that you're probably going to see when it comes to investing. You've probably heard of capital gains rates. These are very, very important when determining when to buy and sell securities. So it's very important here to understand how short-term and long-term capital gains work. So short-term capital gains pertain to assets that are held for 1 year or less, and these are taxed at ordinary income rates. So, if you buy Apple today for, let's call it $100 and you sell it tomorrow for $150, well, you have a capital gain of $50. So ultimately, that's the same as you making an additional $50 in your paycheck. So typically, ordinary income rates are going to be higher than long-term capital gains rates. If you hold that stock, ultimately, if you bought that and you hold it for a year and a day, that's very, very key. You have to hold the stock for a year and a day. You're going to pay long-term capital gains rates, which are typically lower, either 0, 15, or 20%. Now, there is one exception. So as far as the sale of your principal residence, this is a loophole in the IRS system. So if you live there in 2 out of the last 5 years, you can exclude up to $250,000 on that gain if you were to sell your piece of property. So that's if you file a single tax return. If you're married filing joint, you can actually exclude up to $500,000 on that principal residence. Let's get into the value of tax deferral. So we touched on this a little bit, but this just gives you a visual. If you were to invest $20,000 in year one over the course of 30 years with a 6% annual growth rate and a 28% tax rate, this just shows you what your ending balance would look like here just due to the value of tax deferred growth rather than paying taxes in either an individual or joint brokerage account every single year. Here, we're just going to demonstrate the power of compounding. So let's say you contribute $120 to your retirement plan on a biweekly basis, assuming a 7% annual rate of return. Your results would look like this. So if you invest that same $120 on a biweekly basis, after 10 years, you'll have $45,000, $45,100. After 20 years, a little over $135,000. And after 30 years, $318,000. So it just goes to show you that the earlier you start saving, the earlier and longer you will be able to let the markets work in your favor and ultimately take advantage of the power of compounding. This is once again just another slide that shows you the benefits of starting early. So if you take a look here, Susan is our first investor that invests $5,000 annually between the ages of 25 and 35, so 10 years. You'll see hers in the gray line there. She invests a total of $50,000, and she has approximately $602,000 at age 65. So Bill invests $5,000 annually between the age of 35 and 65. In total, he invests $150,000. He has even less than Susan does, just given his time horizon. He has approximately $540,000. Now, Chris invests $5,000 annually between the ages of 25 and 65, so 40 years. In total, he invests $200,000, and you can see his portfolio, just given where things were with the markets and the power of compounding, his portfolio is well over $1.1 million. So the long and short of it, if there are any younger folks, here in the audience, this should hopefully give you some ammunition here to ultimately get on the horse and start saving, whether that's just into an individual investment account or perhaps it's your retirement account. Ultimately, this just signifies and demonstrates the power of compounding and starting early. So you may have heard differences between pre-tax investing and after-tax investing. So here we'll just demonstrate the differences between pre-tax and a Roth, especially inside of a retirement plan if you happen to have one. So with pre-tax investing, ultimately you get the tax deduction now. So for the sake of numbers, if you make $50,000, you contribute $5,000 to your retirement plan. It takes your annual income down by $5,000. So, you're only taxed at the federal level on $45,000 there. Any of those funds that go into your retirement plan or that tax deferred account grow, and ultimately you only pay tax when you take a distribution. So all of your dividends, capital gains, interest, all of that continues to compound inside of that account. And ultimately you only pay taxes when you take it out. With the Roth, it's actually the opposite. So with the Roth side of the 401k or even a Roth IRA, you pay tax on your dollars now. So as soon as you get paid, those dollars get funneled into the Roth side of either the 401k or a Roth IRA. And provided the Roth has been open for 5 years, ultimately, and you reach age 59 and a half, you can use all of that cash completely tax-free for any purpose. So one other item to note here, and I'm sorry I don't have a slide on it, but it's very, very important to note too, one of the key differences between pre-tax accounts and Roth accounts is that pre-tax accounts are subject to required minimum distributions. Right now, that's actually set at the age 73. That's when the IRS states that you actually have to start withdrawing from your accounts. Very important to note that Roth accounts, Roth IRAs, Roth 401ks, due to some recent provisions and changes in tax legislation, you never pay tax on those dollars provided you use them after age 59 and a half. So here's a pretty neat scenario. This is, ultimately newer in the investment landscape. So I did want to touch on it. So I wanted to talk a little bit about tax optimization by leveraging technology. So here is how it works. So there are programs out there, given everybody's investing and tax scenario is different, but investors have the ability to work with their outside advisors wishing to mitigate the impact of taxes on their portfolio. How it works, you establish an annual tax budget. So let's call it anywhere, from 0 to 50,000 to 100,000 in capital gains for the year. So you identify an annual tax budget and identify that max band. So anywhere from 0 to $100,000 in allowable capital gains for the year. Ultimately, that's going to be the band that you work around when it comes to portfolio management. So in doing so, what the managers technically try to do is they want to offset your gains and losses throughout the year when possible, and deferring gains. As I mentioned, some of those, if you bought Apple today, you sell it tomorrow. Well, hopefully, there might be an opportunity for some of the securities in your portfolio to ultimately wait and sell those positions at a later date so that you can achieve long-term capital gain status where applicable. I'm sorry, we've got a question here. Can I use my disability payments for investing in a Roth IRA or 401k plan? That's a really good question. So I need to go back and double check on disability payments. It's my understanding that with a Roth IRA, you actually need earned income. So I just don't know off the top of my head whether disability payments qualify. My thought is that they don't, but the way the tax law reads right now is you need earned income in order to contribute to a Roth IRA. And I will follow up. I'm more than happy to get the answer for you on there. So I will definitely provide my contact info. So getting back to the tax optimization use cases here, why would I use this strategy when it comes to portfolio management? Well, as I mentioned, some folks have really, really complex situations. So one of them being concentrated stock positions. So this allows investors to unwind and diversify concentrated positions across multiple accounts in a tax-efficient manner. So if you hold Apple, for example, or Microsoft, or any different security for that matter across multiple accounts, well, using this technology here, you can actually select the individual tax lots. So, if you bought Apple several times over the last 20, 30 years, well, you can unwind that in as tax efficient a manner as possible utilizing this strategy based on those capital gains parameters. Another use case scenario, this is pretty neat. So think of business or a property sale. So say that you have a vacation home and you bought it for $250,000. You sold it last year for $500,000. Well, the difference between $500,000, your sale price, and your cost basis, $250,000, you've got a $250,000 gain that you're going to owe capital gains tax on. Well, what you can do here utilizing this strategy is if you typically have your investment portfolio and it generates $250,000 in annual capital gains, utilizing this strategy, you can actually pull that band back and ultimately set that so that your max capital gains allowable for the year are, you can set it to whatever you want, whether that's 50,000, 100,000, what have you. I've seen this in real life and it works really, really well. Ultimately, you can pull in your capital gains allowable for the year if you have a one-time transaction like that. So you already know that you're going to owe $250,000 worth of capital gains on the property sale. So why not rein in some of the allowable capital gains on your investment portfolio? Because it could potentially, this situation, these investors are probably in a high tax bracket anyway. But if you're trying to, stay within a certain tax bracket, ultimately, this could be a really, really good strategy. And finally, one of the other use cases for this might be asset transition. So This provides a solution to transition a portfolio of tax-inefficient mutual funds and or positions with low cost basis to a well-diversified portfolio constructed of individual securities and alternative investments. So this really reduces the tax drag on your portfolio. So just wanted to throw these out there. This is a relatively new concept, and there aren't a whole lot of folks out there with access to it. So just wanted to throw it out there just in case anybody happens to see this in the news or picks up a periodical. So here, I know I'm running kind of button up right on 7:15 here. So I know there's a lot to consider. Main thing here, feel free, ask questions. When in doubt, there's plenty of information out there. Make sure you work with a trusted professional. There's a lot to consider when it comes to tax considerations, different types of investments that are out there. Always be wary of what fees you're paying. Understand where you're putting your money is ultimately, the main focus here. So as I mentioned, I'm just going to provide my contact information here. I'm going to hang out, for the next couple minutes here. I'll hang out as long as anybody wants to, if anybody has questions, but feel free. If you don't want to ask questions here in front of the group, please take my contact information. That's my direct line along with my direct email address. So I'm more than happy to answer questions offline. I know I do have one or two items that I need to follow up on. They were actually really, really good questions, especially regarding whether disability payments are considered earned income. So I promise I will follow up and get those answers. So couple questions look like they're trickling in here, so I'll do my best to answer these. So what are ETFs? That's a great question. So ETFs are exchange traded funds. So they're similar to mutual funds, but they're different. So as far as that goes, a mutual fund is a basket of securities. They trade once a day. Their net asset value, which is the fair market value for the fund, is priced at the end of the day. On the other side of the coin, ETFs are similar in that they're a basket of securities, but they trade intraday. So their prices fluctuate just like individual securities. So it's going to float just with the stock price, just as Apple, Microsoft, Nvidia, Facebook. Just as those stock prices fluctuate throughout the day, ETFs are readily tradable throughout the day too. So one of the dangers of ETFs or benefits in that regard, depending on how you see it, is ultimately you can experience big swings in the value of ETFs throughout the day. Mutual funds, not so much, since they're priced at the end of the day. So does that answer your question there, Carol? Got a lot of really good questions coming in here. Where do CDs fall in the investment spectrum? So CDs are going to fall into the safe bucket. So, CDs are, most of them are FDIC insured. So from that standpoint, I would lump that in with cash. So, CDs, money market, anything that's backed by the full faith and credit of the U.S. government. Ultimately, CDs are really interesting now. They haven't been really fun to talk about in the last couple of years because the yields on them were just so small. So, just keep in mind that interest rates are pegged to the 10-year treasury. So, this year rates could potentially come down. I know the Fed, increased them last year quite a bit just to curb inflation. So, CDs are ultimately priced off of that 10-year treasury rate. So they're at the end of the day, a lot of them are bank products. So there are ultimately some structured products that are a little more intricate. There are market linked CDs. There are all kinds of different vehicles out there. So just make sure you know what you own. But CDs, you can go out anywhere from, you can get a 6-month CD, you can get a 2-year CD, a 5-year, 10-year, what have you. So, I would also be cautious just, if you're thinking about purchasing CDs, be cautious as to how long you're locking yourself up for. So if you surrender a CD prematurely, some of them trade in the open market, and typically you're going to surrender some of the interest that you're due. How do you buy muni bonds, and where are they first issued? When were they first issued? So I actually don't know the answer to the second question, but how do you buy muni bonds? So you can buy those on an exchange. You can buy those, through either an ETF or a mutual fund structure. You can buy those through a specific manager. Muni bonds are really interesting in that you can either go with a national bend or you can go with a state-specific bend. So, from a muni bond perspective, the interest on a muni bond versus a corporate bond, muni bonds are federally tax exempt. So that's one of the beauties of muni bonds, is that a lot of high net worth investors tend to like them in their portfolio on the taxable side because they're exempt from federal income tax. So if you live in Maryland and you buy a Maryland muni bond, this is one of the neat things too, is if you live in the state and you buy your state's muni bond, typically it's exempt from state taxes as well. So it could be potentially tax-free both at the state and federal level. So a lot of folks really like to incorporate those into their portfolio as well. But one of the things you got to watch too with munis is you always want to make sure that you vet the credit quality and ultimately the backing of the issuer. So, Sarah, curious if a target date fund is considered adequately diversified in and of itself, or if additional types of investments are needed to diversify. So that's a good question. So you want to keep an eye on what's called the vintage of the target date fund if you're selecting one. Typically, target dates correspond with a year. Whether right or wrong, they assume that everybody retires at age 65. And the vintages, as they're called, are typically in blocks of 5. So if you look and you have a retirement plan, and if it holds Vanguard 2025 or the Vanguard series, Fidelity Freedom Index series, what have you, ultimately they're all pegged to a year that corresponds in blocks of 5. Whether right or wrong, as I mentioned, if you defaulted into one because you either didn't make an investment selection or you checked the box that said "do it for me" regarding investments, it's most closely pegged to the year you turn age 65. They do tend to be well diversified, but the main thing you want to watch is how risky is the target date fund? Because those that are farther out, if you're a 65-year-old and you buy the Vanguard target date 2070 fund, well, that's going to have a ton of equity exposure in it. That's meant for somebody who would potentially retire in the year 2070. So that would probably be appropriate for a younger investor. So I would really, really vet the target date funds that you have access to, and just make sure that you're invested properly and you select the right vintage. Kelsey, in general, is there a recommended percent of, say, your monthly or yearly income that you should put towards investments? So as a financial planner, our goalposts, what we recommend as far as I would say your retirement accounts, long-term retirement savings, and everybody is different here. But if you can strive to get to between 12 and 15% of your gross income annually, setting that aside towards your retirement funds, we think typically, by the way the math works, you should be in pretty good shape. And please keep in mind, if you do have an employer match, we know that number may be daunting for some folks. So that employer match does ultimately get added to that number. So, if you're shooting for 15% of your long-term retirement savings, your employer match is 4%. Well, what can you do, to get another 11% in your portfolio? So, we always recommend start small. We know, everybody's in a different financial situation, different place in life. Ultimately start small and, do what you can to increase that on an annual basis. Is it better to buy ETFs or mutual funds? So one of the things you want to watch is transaction fees. So it really depends on where you're buying these. So there isn't a right or wrong here. It really just depends on, how your portfolio is crafted. There is no magic bullet here, whether, to buy an ETF or buy a mutual fund. The main thing you want to watch with both of them is called the expense ratio. So that is, you can think of that as what's called the cost to operate the fund. All of those can be found in a fund's prospectus. You can either go on, Yahoo Finance, and I think you can type in the ticker symbol in order to get the expense ratio, the underlying funds. Some mutual funds and actually some ETFs now are active and some are passive. Passive funds tend to track an index or just a basket of stocks. Active mutual funds and active ETFs are traded regularly. So there are some tax consequences you may want to watch with those. And ultimately, you want to watch the expense ratios of those underlying funds. can you explain business property sale use case for tax optimization? Absolutely. So let's take the business case. So ultimately, if you built a business over several years and you decide that you want to have a liquidity event and you sell it for $5 million. Well, first of all, you need to figure out what's the cost basis of the business. Let's just say that, after you do a business valuation, let's just call it was $4 million and you sold it for $5 million. Well, you have $1 million long-term capital gain from the sale of your business. Well, you also have your investment portfolio that typically generates capital gains for the year. If your capital gains in your investment portfolio are typically, $250,000, $300,000, $400,000, for example, well, you just had a one-time event where you already know you've got a capital gain of $1 million on a business sale. So you don't want to owe more tax than you already need to for that year. So ultimately, what you can do is utilize some technology, perhaps, in order to put some guardrails, if you will, around your investment portfolio. So I know those numbers are large, but these are use case scenarios. We've seen it. It works really, really well in this scenario, especially the long and short of it is it's a technology that you can use to offset some capital gains or one-time events that may be non-related to your investment portfolio, if that makes sense. And I'm more than happy to talk offline about it. It's intricate, and it's only for the right investor. So I'm just throwing it out there because it's a relatively new concept, but in the event that it's needed 100% of the time, and it's worked really, really well. Is there a joint IRA option with a working spouse? So by design, IRAs stand for individual retirement accounts. So ultimately, there are a couple different things you can do. You might be able, depending on what your modified adjusted gross income is, you could open what's called a spousal IRA, provided you're under a certain income limit. The IRA rules are quirky. So, you always have to, figure out, am I eligible to make an IRA contribution, whether that's a Roth or a traditional IRA? And specifically, there are rules around whether you're covered by a retirement plan. You might not be able to deduct your traditional IRA contribution, which is the one that we run into the most. Roth IRAs, those rules are quirky as well. And one of them, the one that's probably the most prevalent, the one you want to watch with a Roth IRA, is whether or not you make too much money in order to contribute to a Roth IRA. So not everybody qualifies. And there's nothing worse than throwing money in a Roth IRA. It's grown since you put it in. You were making monthly contributions. You file your tax return for 2023, and now you got to figure out how to get your money out of the Roth. So we've seen it. It's a pain in the what. So it's one of those things that just make sure you're eligible to contribute to the appropriate buckets. What are tax shelters? So not too sure what you mean by tax shelters. I'm happy to take that one offline, but perhaps that's just due to some of the tax buckets that you can use to shield your investments from taxes. If that's something you have some interest in, I can certainly get you some information. What is the average cost of a financial advisor? It really varies. It does. Typically, historically, we've seen anywhere from probably 1% to 2% annually based on an asset management charge. Other advisors charge commission. So it's really, really important just to ask the advisor, how they get paid. And in addition, make sure you're getting the value that you're seeking. So, you should definitely make sure that, if you're seeking a financial advisor, he or she is very candid as to how they get paid. Rhea. Awesome. And I'm sorry, I know I whizzed through those because I'm just trying to be cognizant of time. But are there any other questions? I know we're coming up on 7:30. I'm more than happy to stick around. Or if you just want to, shoot me an email, give me a call if there's anything that I missed or anything you want some clarification on. I promise if I didn't have the answer for you tonight, I am more than happy to see if I can dig it up for you. And I promise I'll get back to you.
Thank you so much, Scott. I think this has been really phenomenal. You've covered so much of ground and you really got through all of those questions. And thank you for sharing your information so that if there are any further questions, we can get back to you.
Great.
And thank you everyone for joining us today and taking time out in your evening with us. This event has been recorded, but we will be putting it in for editing, and it'll take me a couple of days to get it out to you. There's still some questions popping in
Okay.
the chat, but I think perhaps they could reach out to you directly.
Absolutely. Absolutely. So, and please feel free if, Rohini, if we need to distribute my contact info, after this, feel free. If you have a list of participants you want to send it out to, if they didn't quite catch it on the Zoom call, please feel free. I am readily available and I'm happy. I'll answer as many questions as I can. And I promise if I don't have the answer, I'll try to get you in touch with somebody who does. So.
Thank you so much. And that's a great idea. I will share your contact information in the follow-up email, so everybody has that.
Great. Perfect. Well, hey, I just want to thank everybody for their time. And Rohini, thank you again for having me this evening.
Thank you. Thank you so much, everyone. Have a great rest of your night.
Excellent. Have a good evening.